From CRI Simple Numbers, this is Profitability Playbook, the Simple Numbers Podcast, a podcast for those championing market growth and anchoring the nation's economy, small businesses, and entrepreneurs.
Welcome to the Simple Numbers Profitability Playbook Podcast. I'm Brandon Gray. I have with me David Mills from the Simple Numbers team. We're going to talk some acquisitions here in just a second. What you need to know before going into one, what are perhaps red flags as you look at potential targets, what are the most difficult parts of integrating a newly acquired or merged company in with yours. And so we've got David. I'll tell you a little bit more about David here in just a second. This is going to be a good one. It's going to be a lot of fun. So I know we're beating a dead horse on this one, but I got to remind everyone, because I never know when we have new listeners. The Simple Numbers Summit, November 9th through 11th in Austin, Texas. You can go to simplenumbersummit.com and register. We're continuing to have folks register. We've got our sponsors right now in process. Got several folks already signed up for that. So if you're interested in sponsoring as well, we've got different levels. You're going to get to meet with and interact with entrepreneurs that are Simple Numbers clients, those interested in Simple Numbers. So it's going to be a target-rich environment if you're looking to sponsor. So just contact me. And there's also a contact tab there on the simplenumbersummit.com form. Keep in mind, too, if you're new to the podcast, go back and listen to all the previous episodes. We've got a ton of content out there, a lot of really cool guests that are a lot smarter than Mike and myself, which not hard to be. But nonetheless, some really good things there. And if you want to learn more about Simple Numbers, we'll do a free health check on your business just to give you an idea of kind of where things are at. And if there's levers you need to be working on, you can go to simplenumbers.com/contact and fill out that little form. We'll get the notification and we'll be back in touch with you to let you know how you're doing. So enough for the commercials. Let's get David rolling here. So David is one of our Simple Numbers consultants. He comes to us with a background that's a little bit unique to anyone on the team, especially. David's got over 20 years working with acquisitions and also as the CFO. And so he has seen it all. He has seen the good, the bad, the ugly, companies that they acquired that looked great on paper and then it didn't work out, companies that maybe didn't look the best and it worked out, small companies, large companies, integrating them, you name it. David has the experience in that. So we wanted him to come on today to share a little bit of his wisdom. So David, appreciate you taking some time and sharing some things that you've done in the past. We got a lot of clients that are interested, especially kind of given the marketplace and acquisitions. It's very well documented that we have talked many, many times about the importance of, in order to win in the current marketplace, you have to steal market share. And there's a couple of ways that you can do that. One of them is through acquisitions. And in some cases, that's perhaps the best fit. In other cases, it's not. So I guess to kind of get us rolling here, David, kind of just give a little bit of background about what you've done in acquisitions, perhaps even a little bit of background around what you guys would look for as you were kind of in the marketplace and looking to grow the company.
Yeah, so for about 12 or 13 years, actually the boss that I'd worked for, he had this idea to roll up the hardware industry, knowing that many of the hardware chains, the smaller independently owned chains, it started in the 1940s. So people coming back from the war, right after the war, they started a small hardware store, building materials store, usually one location. Second generation comes along and loves what dad has done and starts building it and sees a way for them to have their family make a living, become successful. Then that third generation is desperately trying to sell it. They want to go use that money and play golf. They don't want to be involved in this business. It's something that they feel is a burden, and it's not something that's really a family legacy. So this gentleman had this idea to roll up these hardware stores. So we went out and basically got a partner that said, okay, let's go do this. And very quickly, word of mouth got around that we were doing it. And we, at any point in time, I would say into the first 2 or 3 years, we had 20 open conversations, then 30, then 80. So people were coming to us knowing that, hey, these guys are going to come buy our company. So the one thing that we really figured out early on was it's not about the financials. Sure, you can say, okay, we can afford this company. It looks like they're doing okay. We can probably make them do a little bit better, but there's other things to consider. Early on, we spent a lot of time with a couple of acquisitions where we put in all of our effort, all of our research, all of our due diligence, looking at all their information. And then at the end, they got cold feet and wouldn't sign the deal because they decided that their family would not have liked this. This is not would have been what dad would have wanted. So that was one red flag. So yeah, financials have got to work, but but you've also got to be able to get a deal done. We also figured out that it takes just as much time to buy one location of a company as it does of a company that has 20 locations. So buying a $500,000 company is almost the same as buying a $3 million company because it's the same amount of effort. You're looking at a little bit more data, but you still have to go through all the steps to make sure that what they're reporting is correctly, what they're telling you is right. So, we could spend, a $30,000 legal bill to buy a $500,000 company or a $30,000 to buy a $3 million company. So there were things like that to consider. But probably one of the biggest lessons we learned was how much is this acquisition going to distract from our current ongoing operations? So you go and you say, okay, we're doing really well in what we're doing, and we can come bolt on this small acquisition. But if that small acquisition is dependent on an individual owner, and you think that owner's probably not doing much, but he ends up being the face of the business, you very quickly find out that that little small part of the business, you end up putting everything you've got in that small part of the business to make sure you're making it successful. So we really had to say, okay, financially, this thing's going to work. We can get a deal done. And then if this owner is going to go away, can we run the business without him? How much effort is it going to take? On the flip side of that, if that owner is going to stay and either become a small partner in the business or just an employee or a contract employee for 3 or 4 years to help get us going, is he going to be able to work with us? Is he going to be able to make the changes that we need to make his business successful? So those are a few of the things. And I think the other thing is probably change management. A lot of so we bought businesses that some of them were distressed. Some of them were doing very well. The ones that were distressed, a lot of the reasons they were distressed because they weren't willing to make changes in difficult times, whether it's closing a location, whether it's getting into a different product line, whether it's reducing their labor, their staff. That staff was their family. They felt like, so they weren't able to make those big decisions. And when we came in, would they be willing to make those decisions? So there was a lot of things to consider beyond just will they sell and can we afford to buy them?
So let's dig into a few of those a little bit. So one thing David said was, they had a partner, I guess, basically kind of helping to bankroll the acquisitions. So, as listeners and you're considering a potential acquisition, before you get too giddy about who I'm going to go and get and what do their financials look back, probably need to have some idea how we're going to pay for this. And I would say, you've got what I would call the traditional methodology, which would be, okay, we're going to go and get financing through a traditional lender, whether that's an SBA loan or, if you got really good relationship with your local bank and you kind of could sell them on the plan of acquisition. The second one we sometimes see is that, and I like this one as well, the owner's going to tote some of the notes. So you may do some financing. It could be a combination of traditional, it could be some internal capital that you've built up, and then the owner's toting some notes to go with that. And then the third, and the one that we probably see less with our clients, but the PE funds, it's their whole basis, and kind of what David was mentioning there is you find a capital partner, and there are capital partners out there. Now you have to kind of shake a lot of hands, and you've got to kind of get into that network, and it helps if you've got someone who's already uh, kind of swimming in those lanes to make those introductions. But we've had clients in the past to where, they basically will form a partnership with someone to where they're going to bring the sweat equity to the deal, you might say, and the other person's going to bring the capital. And there's some really cool structures that you can put in place whenever that is the method that you're going to use, to where, the capital partner is made whole, and then perhaps they take on a minority interest in that investment. Um, there's other methodologies to where you can use convertible notes. A lot of different ways that you can go about doing that. So I'd say those are probably the three main things that you want to look for there as you kind of decide that you're going to go down the acquisition path. Let's talk a little bit, David, about some of those flags. You mentioned a couple of those. So, if a company kind of came across your desk and maybe everybody's giddy about it because it's the new shiny object and it's in the location that you guys really want to move into, and really great relationship has already been struck up with the existing owner. What were things that you'd either hear in conversation or see in the numbers to where you kind of would go, don't know about this one?
Yeah, so one example, and I think it was about the fourth or fifth acquisition we did, and the gentleman that we were dealing with came across as very genuine, very good guy. His wife was the controller of the company, and he had kind of built this from scratch. And he was an ace dealer, and I think he had got up to like I think 8 or 9 stores, and he was just ready to get out. And he would tell us things about, well, we closed this one store and put all the inventory and all the racking in this other store. So we went to that other store. There was nothing in the back room. It's like, wait a minute, where did this really go? So there were questions like this, and I remember one time driving through a neighborhood with him, and he goes, "Yeah, this neighborhood is growing, and these houses, these are $400,000 and $500,000 houses, and it's a huge neighborhood." And I looked on Zillow on my phone; the houses were about 200 grand, and they had never been that close. And he would paint a story, and just paint a story, and we ended up doing the deal with him, and then figured out that he had misstated his inventory by $1 million. So I think on $5 million of inventory, he said he had six. They just didn't exist.
Wow.
So we ended up spending and this is one where we had to, all of a sudden it was all hands on deck to, now we've got to go run these stores. He's no longer there. Now we've got to undo this deal legally and try to get going forward. And it was just, and what was funny is as we went and talked to our existing landlords with that group, as we talked to the power companies, we talked to anybody who'd ever dealt with him, said that they would never do a deal with this guy again. He comes off as really slick and really good, but he's good at taking care of himself and no one else. And my boss at the time, who he goes, I felt a weird thing about him, but I was trying to overcome it because he sold such a good story. So it's you really got to look at the numbers. You got to really see the things and not just believe what people are saying. It's the things of going, we're growing, but we can't do this except for, well, we've got this deal in the works, but they really don't have a deal in the works. So he was just trying to get out of the business.
Right.
And when we find out that's what he'd done all of his life. So it was definitely an experience, and it changed how we really changed how we approach deals.
A lot of lessons in that one. So the one that kind of stands out, it unless you are unless you have a background in doing acquisitions, unless you're experienced in it, you might want to get a little bit of help in doing that, because they're going to see things that you haven't seen before. The third party has no emotion in the deal. And so they're going to question sometimes those stories, like you said. They're going to pick up on the ifs and the buts and the maybes and some of those kind of things. And then just from a financial perspective, definitely the larger the deal, the more you have at risk should you miss something in the financial review. And so probably a good idea to bring in someone to do some due diligence around it. We got one going on right now with a client that, and we're not a due diligence firm. Don't get me wrong. We can take the initial look and kind of go, guys, these are some things you probably need to look at. And, we can make some recommendations as to folks who are experts in due diligence. But their ongoing job schedule or the equivalent in a retail environment would be their inventory. Have they had an inventory audit done? How accurate is it? What is their inventory process? And then on the service side, looking at their job schedule and get one from the same time in the prior year. Has it magically just grown by 30 or 40% whenever the market's not moving? You know, uh, many times, even though numbers are an outcome, they will give you some idea that will really kind of help your gut sense, perhaps raise a flag. There's another one right now that a client of ours is looking at. And if you look at the last 4 years, they've had a 2 years that are mediocre. They had a phenomenal year. And then the most current year that's not closed out yet looks to be even better. And so you're kind of going, what happened here? Why did all of a sudden things just take off? And this is a mature business. This isn't one of those to where it was, they were growing it and planting the seeds and what have you. I really like what you said, that the comment that the owner gave you around, yeah, my gut was telling me something's off, but I just wanted to ignore it because they told such a good story. If your gut is telling you something's wrong, there's probably something wrong. That gut won't lie to you many times. So like that. David, speak a little bit. You made a comment there too around when you kind of look at the resources you have to devote, whether it's a $500,000 acquisition or a $5 or $10 million acquisition, that it's about the same amount of time and resources. So just kind of speak to that scalability, perhaps.
Yeah, I mean, you still have to look at the leased property. You still got to review the leases. You're looking at an employee roster, whether that employee roster is 10 people or 50 people. You've still got to go through all of the same steps and all of the same analysis. And it really it's something that's very scalable. You wouldn't think it is, but it doesn't take much to run through an AP report and sort it and slice it and dice it. Whether it's like I said, $1 million company or 3 million, there's really not much difference. You got to do it no matter what. You're going to devote those resources to it. And in the end, what you get back, you want it to be worth what you put in. And I also say one thing I forgot to mention too was a lot of the companies that were our best acquisitions over the 30 or so that we did were really diamonds in the rough. They were the ones that when you looked at their financials, you would go, I think there's something here that we can work with, but they weren't making the decisions they needed to make. And since I've been at Simple Numbers, LER just comes to mind on everything. And that's really what every company's problem was as they reduced their volume, as competitors came in, they just were not reducing their workforce and they could not make those tough decisions. And we were able to come in there after the acquisition and really we would discuss it before the acquisition with the owners and say, hey, here's the list of people that need to go. Here's the list of positions that we need to eliminate. Here's how you need to right size what we're doing and really just have a geared approach because, we had many conversations where if you keep everybody, nobody's going to have a job.
Right.
And we ended up having one company where their gross margin each week would not even cover their payroll. Let's forget about covering, rent, covering utilities, and they weren't going to make it. And they were one of the most, 3 years later, they were a huge success story. And the lady that owned that stayed on with us, she was third or fourth generation from that company. And she would give speeches to some of our new acquisition targets and would cry. I mean, it was genuine. She's like, my company was going to go away. My history, my legacy was going to go away because we couldn't make tough decisions. And they came in here and helped me do what was right. Right. And then she wasn't the bad guy. She was the one that helped save everybody. So there was a lot of interesting stories over the years.
It's probably been 20 years ago. I heard someone speaking about as they look to make an acquisition, what they would look for. And it resonates with what you just said there, David. So they said, each business is a stool and that stool has 3 legs and you're looking for a leg that is broken. So the legs were, is on the sales, marketing, business development side. So, great operators, but they can't sell to save their life. And if you can't sell, then don't go buy that company because it's not going to help, But if you're great at sales and they got a sales problem, that can be a potential. The second was operations. Maybe they could sell all day, but they just could not consistently perform the work and deliver the way they needed to deliver. It's just broken. Well, guess what? If you're great at operations and you're bad with sales, that could be a really good marriage. Now, there's going to be some heavy lifting to get them to adapt, but that could work out. And then the third was on the financial side. So, and that could be on a couple different fronts. It could be around profitability. Some of the things David was mentioning a moment ago, they're great at sales. They're great at executing. They're just spending way too much labor to make that happen. They could have margin and pricing issues. That could be one. They could have an overhead that's out of control. They could have a balance sheet that needs restructuring because they're pretty much being hindered by their cash flow cycle. Things like that. And so find a target that has a broken leg on that stool, and then look to see, do you have the resources and the expertise to repair that leg? And those can be really great success stories. As David was saying there at that, I would maybe it's a desire that the existing owner has that they want to keep the entire team. And maybe it's you wanting to go, okay, I don't want to have a labor reduction and be the bad guy coming into this. No, those are real considerations, but you've got to look at what does the data tell you. And with clients of ours who have done acquisitions, here's how the story usually goes. They've got a sales team. It's okay. It's not great. We're going to bring them in, give them a chance. Or they've got 2 or 3 people that maybe have been with them a long time. They're over their heads. The company's growing faster than they can, but we're gonna roll them in and kind of see how everybody performs and yada yada yada, and all the stories go. You guys can probably see where I'm going with this. Guess what percentage of the time, David, I've seen our clients who have we're just going to keep everybody and roll forward and it's just magically going to work. Guess what percentage of the times I've seen that work?
Probably 0.
Yeah. And David and I didn't discuss this beforehand. You're exactly right. You get 6 or 9 months into it and you finally, and the data tells you once again, you've got to make a change. There's a reason why they were not profitable when you first started looking at them. And just bringing you together and putting a different logo on what they do and you integrating them many times doesn't magically make them profitable. And so you go 6, 9 months, invest in all those salaries and all that comp, and then you go, okay, I got to make a change. So now we've burnt through all of our startup capital.
I'll say one more thing. When you were talking about the leg of the stool, that the overhead piece, there were several occasions where if a company's not doing great and they're trying to find every solution possible, they just do technology gone wild. And they try to put in every software solution that people would say will save them money, make them more efficient, help them in every way possible. And, we went into places that had millions of dollars of software subscriptions and halfway done implementations. And it's like, you can turn all of this off today and you're not going to hurt your business at all. And all of a sudden you're not paying all that overhead. But it was a combination of a technology person that says, hey, I can solve this problem for the business. And a tech person is usually not going to solve that problem. It's going to be in operations or it's going to be in sales. It's not the tech guy.
Yeah, going and buying a bunch of Snap-on tools doesn't make you a mechanic.
Exactly.
All right. Well, we're getting kind of close here. That's at least David's given us some really good things. We're getting kind of close on time. So, David, I guess as we kind of wrap things up here, what advice would you give our listeners who are considering an acquisition? What are some things just with your experience that you'd throw out there of, hey, these are things you either want to check off your list or be aware of as you kind of consider swimming in those waters?
The biggest thing is if you're super excited about an acquisition and the person you're acquiring it's probably not going to be a good deal for either one of you. There's probably some on one side or the other. It's kind of like a divorce. You can't be completely happy. I mean, both sides have got to not be happy with what's going to happen. So there's that piece. I guess the other piece is it's not all financial. There's so many more things that can negatively impact your business. Just because you can make the financials work, if you've got to put too much effort into that acquisition and you take away from your core business, it's going to be painful. And we learned that the hard way. You got to focus on that core business. That acquisition needs to be bolt on. It needs to be additive. It needs to be something that's going to add value, not something that's going to distract attention.
Great info. I'll add a little bit of color to that because I can't help myself. So, as David mentioned, if everybody's happy, there might be a problem. We like to define a fair price and a fair deal to where you feel like you gave up to, or the buyer feels like they gave up too much, and you feel like that you paid too much or made more concessions than you should have. That's usually kind of where you find equilibrium when neither are really happy, oddly enough. And secondly, do not take your eye off the ball of your existing business. This was several years ago. We had a client going to market. They had performed really, really well. The whole go to market, they were looking to sell their company. But this would apply with the distraction of an acquisition as well. It takes tremendous time. It takes tremendous resources. And I would say that's one thing a lot of entrepreneurs will not completely have their hands around, whether they're selling to someone else or they're looking to acquire someone else. The amount of resources that it takes to pull off a deal. I mean, it's going to be your full-time job for the next 3 months, most likely, as you kind of go down that path on either side of the equation. So this client was looking to make a transaction. They take their eye off the ball a little bit. Not a big deal at first. It drags out. It drags out. It drags out. 6 months later, they have to send updated financials, and the purchaser had noticed the declining trend. They're like, guys, we don't like this. It gives us cold feet. They stepped out. It took them 18 months to get back to where they were at originally. And then they went to market again. And the second time they learned their lesson. They actually increased performance as they were getting close to a close date. So yeah, don't take your eye off the ball, because bad things happen when that takes place. Well, David, this has been great. For those listening, if you're looking at an acquisition, if you think you want to acquire, contact us. Let us know. We're happy to have a conversation with you about it. We can bring David into the loop, and he kind of can, give it the old sniff test in terms of your company and what you're looking at doing, and kind of go, all right, guys, yeah, this might have some merit to it, or we need to go look elsewhere. And like I said, we also have a team available that can help with due diligence. If you're looking at company, if you're knowing that you're wanting to merge or acquire and you don't know who to go to, we've got a company, our sister company, CRI M&A team, that has tons of contacts in the marketplace of folks that are interested in selling. And, like David said, it's that third generation many times that's looking to exit. There's a lot of those folks out there right now, so it can be a good opportunity. All right. Hope everybody enjoyed this one. We've got some fun things upcoming at Simple Numbers. Mike and I are going to be at our Simple Numbers Mastermind next week. We're going to take a group, I think around 10 to 12 clients, out to Bishop's Lodge in New Mexico, 5-star resort. We're going to spend a day and a half with them, going through their data in a group setting, getting some group coaching, some group feedback. You talk about an impact event. So we're excited for that. As always, if you got topics, things you want to hear about, let us know.
If you want to know more about driving sustainable profitability for your business, or are interested in learning more about CRI Simple Numbers, please visit our website at simplenumberscri.com. Thanks for listening to this episode of Profitability Playbook, the Simple Numbers Podcast. You can subscribe to Profitability Playbook on Spotify, Apple Podcasts, or wherever you prefer to listen to podcasts. If you like what you heard today, please leave us a review. This podcast is brought to you by CRI Simple Numbers LLC, a division of CRI Capital Group LLC, and a subsidiary of CRI Advisors LLC. CRI is the trusted brand under which Carr, Riggs & Ingram LLC, the CPA firm, and CRI Advisors LLC, along with its subsidiaries, deliver professional services. Please note, Carr, Riggs & Ingram LLC is a licensed independent CPA firm offering attest services, whereas CRI Advisors LLC and its subsidiaries specialize in providing tax and business consulting services. These entities operate within an alternative practice structure as defined by the AICPA Code of Professional Conduct and comply fully with applicable laws, regulations, and professional standards. Ready to simplify your business finances and drive growth? Explore valuable resources, books, and tools designed for entrepreneurs and small businesses at simplenumberscri.com.